It was more emotional for me than I realized because it was my whole life for so many years. And then losing control, it would have been easier if I had purpose. And I didn't feel like I had purpose post that acquisition.
How much a company fundraised or they got acquired is like meaningful on their last day, but what after taxes lands on your bank account is there. But that can be totally different. I mean, we had like maybe not the largest exit on earth, but I know that I didn't do that bad versus much other companies who raised much more, had much bigger numbers, and the founders had, I don't know, a third or a tenth of what I got out of it.
Good evening to me and good morning to you. And wherever everyone else is watching this from, I suppose it's all around the world. So we will have a bit of a morning, maybe nearly afternoon and evening vibe going on here. All right, guys. So thank you all for joining us today. We are doing our Exited Founder Acquisition Roundtable. This is the first one we've done on Bricks and Bytes, but we've spoken to all of you at least once on a separate deep dive kind of vibe. But here it's good to get you all in a room and talk about or shoot the breeze on really what happens in the acquisition process when you go through the process of selling your business in the construction tech industry. I'll let you guys do introductions to each of yourselves, but just to let everyone know what we're going to dive into today, we will cover a few topics. Number one being what needs to be in place for your company to be an acquisition target. We'll talk about how the acquisition interaction starts and progresses, what founders should think about before they enter a negotiation, the process, lessons from your exit that you bring with you today. And then I have some pre-submitted questions from people, which we sent out a Google form for. But I also appreciate that when we've done these before, people post questions in the chat. So we will see. We'll try and get through as many as we can, but we have a lot to get through. So with that, shall we dive on in? Question?
Yes.
Question number one. I have a bit of an order for you guys, so I'll ask a question, then we'll go through the order. But so in one sentence, you could tell us what you built, what you sold it for, and what's the one thing you wish you knew before you started your exit journey. Mo, you take to the stage, my friend.
Yes. I'm Mo, and the team and me, we built HoloBuilder, the first reality capture progress tracking software SaaS solution around 10 years ago, 11 years ago. And yeah, we exited the company in 2021. And it was for around $36 million to FARO Technology, back then a public company.
And Mo, you guys were like the pioneers of reality capture, yeah? Very big industry these days.
Yes.
Much more, I think a lot more funding now
first one.
than when you were in the trenches.
Oh, yeah. But it was a really good time.
Good. Zach, how about you?
Yeah, Zach Scheel, co-founder and former CEO of Rhumbix, a field and workforce management solution. And yeah, most recent acquisition of the crew here. We're about 5 weeks post deal signing and closing. So just started my journey at Autodesk, and the purchase price is not public, so can't say a number, but it was a price that our investors and our team, everyone was very happy about.
Very cool. And yeah, I would encourage people to check out the interview that we've done with you. It was probably about four weeks or so ago now, maybe 5 weeks, going into a bit of the acquisition. Nice. Yves?
Yeah, and congrats, Zach, again, because this is super fresh. Yeah, so once again, Fieldwire, we were a full management platform that expanded into a full construction management platform. We started the company in 2013, and we got acquired in 2021 when we were about 100 people in the company. And I did 3 years of post-ac after that, and I left when the company was around 300 people.
Very cool.
And I mean, you asked what's one thing you wish to know before. Having gone through the acquisition once, I mean, that was our first acquisition. That was my first acquisition, at least. I would say it's a bit of a one-way door process. I think we had many acquisition offers through the life of the company, but we didn't entertain those seriously. I think it's very different when you go through the process with the expectation that it's going to be successful. And I think if that process had failed after due deal and everything, I think it would have changed the company a little bit. So it was really important once we decided to go through with it that it was successful. At least that's my belief.
Insightful. Cool. Thank you for remembering the last question, by the way. I'll go back to Mo and Zach for that in a second. But Dustin, you could go next. I feel like people probably already know you if they know Bricks and Bytes, but we can recap.
Yeah, so Dustin DeVan, I was the founder of BuildingConnected. We got founded in 2012 and we got acquired in January 2019. The transaction was 275 in cash and 40 million in stock. We were 190 to somewhere between 190 and 200 people, depending on when people's jobs started, the offers, you're adding people. I think, well, one, we should talk about once that process starts, it's hard to unravel. I agree on that comment. I think the thing I wish I had thought about a lot more and had, even during the diligence process, spent more time thinking about. I was just thinking about getting the deal done. From the founder perspective, I wish I had defined more what my contribution would be post-acquisition with the acquiring company and got better clarity. I also wish I had an employee attorney, and I wish I had not bent on traveling. I shouldn't have let them ever give me anything other than first class. I should have held firm on that. Could have got that one through. I know I could have. And too many trips where I was in economy on the upgrading myself, and it really annoyed me.
That is so funny. There's maybe a few things to unpack there. Before we go there, Mo, do you want to answer about the thing you wish you knew before you started your exit journey?
I think that's the same things as Justin just said. I think I wish I would discuss, like, what role would it be to be in? I mean, I had something in my head, but that was probably not the same thing they had in their head, or what I assumed it is, what the company is thinking when I was telling them that. And that was, I think, comes to the next questions or the process. What role will you play and in the company, and probably also know why are they buying you? Yeah, that's it. Really could be totally different reasons. I guess that comes to the next question. An employee attorney is definitely also a good idea, or your own person who you take on site and try to get some benefits. But I mean, that's about the lockup or whatever, but okay. I had nothing. So I checked everything was good for my end. But yeah, I bet it's a good idea to have it for the next time.
Not first class flights?
Mo, your backdrop's real, right? Those are all your shoes.
Yes.
Yeah. Okay.
Each time. I can open each box for you.
Mo said if Bricks and Bytes ever go to San Francisco, he's gonna give us a custom pair of Bricks and Bytes dunks. So when we're there, looking forward to it. Zach, how about you? What did you wish you knew?
Yeah.
Before?
No, I was fortunate in that everyone else on this call and a handful of other founders had already exited before us. So I was able to get a lot of good lessons learned, and also had the benefit of having ChatGPT and Claude to ask questions about things to go through, which was a huge advantage and saves a lot of legal bills. It's super tactical, but the one thing that would have been better to understand before kind of it became critical path and closing was just how working capital works when you're doing the final kind of cash consideration spreadsheet and flow of funds. And it can be swings on the order of hundreds of thousands and millions of dollars in terms of AR, AP, and thankfully I had a very good VP of finance that kind of owned that whole process. But had I not had that individual, it's something that learning on the fly while the deal's about to close is not an ideal situation.
Do you got the first class tickets in?
I did not first class ticket.
Man, This is real advice on the first class thing. One poorly managed incident. That's all it takes to demolish the entire profit on your project. And right now, the only thing standing between you and that disaster is your superintendent showing up at 3 a.m. buried in paperwork before the day's even started. That's why Breadcrumb exists. Not to add more technology to the job site, but to give the people running it tools that actually work the way they do. Safety plans signed off, orientations completed on any phone in any language, permits processed without the back and forth, no paper, no chasing signatures, all synced directly into Procore. With OSHA penalties reaching into the tens of thousands, that kind of oversight isn't just a nice to have, it's everything. Over 1 million workers across 50,000 projects globally have Breadcrumb in their pocket. Book a demo at breadcrumb.co. That's breadcrumb.co. Links in the show notes. Major construction projects are complex, and construction managers know that every day things don't go as planned. Unfortunately, most don't know what and why until it's too late. The best construction leaders know that the secret to delivering on schedule is for everyone to be planning together, committing to targets, and tracking their performance every day. By combining look-aheads, weekly work plans, visual staging diagrams, and daily activity briefings into one multiplayer platform, AFEX is where the world's leading projects are planned and coordinated. Join the largest projects and contractors across Europe, the UK, Asia, Australia, and New Zealand and discover why at afex.co. In construction, precision matters. Every budget line, every schedule, every document. But too often, project data is scattered across tools and departments, creating risky silos. That's where ArcDesk comes in. ArcDesk is the all-in-one construction management platform designed to connect your entire project operation, from opportunity through to tender, all the way to handover. With real-time dashboards, cost control, scheduling, procurement, and document management in one place, ArcDesk gives you complete visibility and control. Trusted by contractors, subcontractors, and asset owners worldwide, ArcDesk has powered landmark projects from shopping centers to Europe's tallest buildings. If you're ready to reduce risk, protect your margins, and deliver projects with confidence, discover ArcDesk today. Visit arcdesk.com, that's ARCH desk.com, and see how leading firms are building smarter with ArcDesk. Hey listeners, I want to take a quick break to remind you about the Bricks and Bytes newsletter. If you're interested in learning about the technology shaping the future of construction, you won't want to miss the valuable insights we share each week. To get this exclusive content delivered straight to your inbox, head over to www.bricks-bytes.com and sign up today. Link is in the show notes. Back to the show. I want to follow up with each of you on one thing that Dustin said. Actually, before I do that, I should have done this in the introduction, but this whole idea of this acquisition roundtable came about because when I spoke to Zach, he said that you four used to drink and do stuff like as before. I don't know if you were like at what stage you were at the company, but you had a tight kind of knit thing going on, and like now you're here, however many years later on this call, so it's kind of strange. Here we are.
Yeah, it was probably like 7 or 8 years ago. We were all part of the brick and mortar portfolio, all in San Francisco, and yeah, we would catch up about once a month, and it was a good crew to kind of ask questions. How was somebody doing this? What did customer acquisition look like? Did you talk to this customer? How'd that conversation go? So it was a good crew in the early days of contact to bounce ideas off each other before there was folks like Bricks and Bytes sharing information a lot more readily with the audience of founders.
I mean, you gotta think this is probably like 2015, like super early contact. This is completely uninvestable as a space. So yeah, it was a very, very different time. Actually, all the exits, like including those four, are part of what has made contact what it is today as a very investable space. People believe it's big. People believe you can create meaningful exits. We talked about it, I think, last time. Like the $100 million curse was very real when we all started. Nobody believed that you could exit good companies out of construction. And obviously, plenty of good founders have proven that it's possible.
Proof is in it.
I remember a lot more just bitching about the space.
For sure.
I mean, it depends.
This is
I
so
am
hard.
maybe an optimist,
Yeah.
Well, I do have a picture from the archives, which I may use for the final YouTube thumbnail of this recording. We shall see. I won't tell you who shared it with me, just in case.
That's awesome.
Okay.
Yeah, maybe the person with the reality capture company.
Always recording. Okay, one thing, just before we move on to the next subject, Dustin, you mentioned this notion of what the I can't remember what term you used, but the composition of your involvement once you have been acquired with the acquirer. Do you say this because that kind of experience of having your own thing, doing whatever kind of, you having full control almost of what you're doing with your company, then going into a larger company where maybe your control is restricted, or you're not quite as free as you perhaps once were? Do you say it because of this reason or for another reason?
I think there's a few driving ideas behind that. The first idea is I've been a part of the corp dev side. And the truth is, when they're buying a company, they're buying the company, and they might not have a plan for what those founders are actually going to go do. Because founders don't have a natural position in large organizations. It's just, are they head of product? Well, are they actually a product founder? Are they head of sales? Probably not. And so there's that component. I think the second component is you actually have an option to kind of lead because they might not necessarily have a great plan. So you suggesting, hey, post-acquisition, here's what I think we should go do, and laying around a roadmap that you guys can get conviction of would probably be a proactive step rather than being reactive and waiting for them to tell you. Because I would bet in most of these transactions, they don't have a good plan. They really like the company, the asset, the fit, the strategies for their overall arching business, but they haven't thought about the tactical stuff. So you know the tactical stuff better, and you can probably lead rather than be responsive to their suggestions. And then I think the last component behind that is, and this is for me, I'd be curious to hear how you all are think about it. When I sold BuildingConnected, it was more emotional for me than I realized because it was my whole life for so many years. And then losing control, it would have been easier if I had purpose. And I didn't feel like I had purpose post that acquisition. I think COVID played into that as well. So it's a very emotional time. So making sure that you find solid footing, I think, would be beneficial for hopefully you getting all of your earn out, which I did not, for the record. Sorry.
Yves, how about you? What do you think about that?
Yeah, I think the experience was maybe a bit different. I did 3 years of post-ac. That was part of the deal. And I would say about half the acquisition discussion. I mean, we basically had 4 discussion with top execs between Javed and I. Javed is my co-founder, and the execs at Hilti before all due diligence. And 2 of those meetings were focused on vision, which is basically the post-acquisition plan. And 2 of those meetings were focused on getting to a price that everybody felt excited about. And after that, we're like, if we can agree on the vision and the price, then everything else will unfold. And by the way, we had a seemingly very easy due diligence after that. And so I think there is 3 aspects to what Dustin is referring to. I think there is a question of autonomy that was immensely important for us. Basically, if I'm going to stay 3 years, I want to be able to operate, and I understand that I'm not part of this bigger org, and I want to have basically just freedom to make the right decision, or what at least I think is right. The second one was kind of like ambitions for the company from a growth perspective, from a product perspective. Where do you want this to go? How fast you want this to grow? And the last one was financing, which is how hard are you going to back this thing up once we're in? Because I remember we had these like acquisition discussions like prior to the Hilti acquisition with other companies. My first question always was, okay, today I'm an independent company. If I want to grow faster, I can go raise money. Tomorrow, if I'm part of your company and I want to grow faster, how do I get access to extra funds? And sometimes people are going to be very honest. You're going to be growing on whatever you make. And you're like, okay, that's a very different trajectory than what I'm doing right now. with this reduced trajectory, can I keep it excited for the people I've hired? Can I keep it excited for myself to operate, right? So to me, those were the three big things. And I think Hilti was very smart. They gave us a lot of autonomy. They gave us like super strong backing. And by the way, like we've multiplied the business post-tax for them. So I think they're super stoked about the value that was created. But they were actually very good at making the macro picture work for us. And I did my full 3 years and I had fun. And you know what? I'm still involved with them as an advisor today because it's been a good experience.
Yves,
I
do you
think-
think
Oh, yeah.
they were like trying to stand up a software company within that organization?
So yes, that is what we're actually doing with Hilti. It's like software now is the third pillar of the company. And they wanted to acquire not only the business to serve as one of the first software bricks, but they wanted to acquire operators that had the knowledge so that we could infuse that in the bigger org. Interestingly, Hilti is a huge group. Like it's, I think, somewhere around $7 billion, and software is still the smaller part. But I think we're having like a massive leverage on the culture of the company in terms of evolving it towards software.
How
Yeah, I
about you,
think
Mo?
that's a
So
big
I'm saying big
difference
company. It's really fun.
on with Eve, that you really came into a company where was, let's say, not much real software besides
Yeah.
the desktop tools for the scanners, maybe.
Mhm.
Yeah, so you were the pillar there, and and I
So
heard you did
that's
a
a great
good job there.
like getting acquired by Autodesk, which is a software company, is probably very different than getting acquired by Hilti, which is like, what do you think we should do? That was kind of like the Hilti acquisition. Sure, when you get to Autodesk, there's a lot of people that have very strong opinion about how you should run your company.
But that, understand your buyer, right?
Yep.
Hey, Mo, how about you? The composition.
I mean, we got acquired by somebody who had hardware and software, which was not great because then really struggled with the software sales and didn't understand software because hardware salespeople would do it. And I think as we got in, I know there are other people on the other side who think they can make their job better or generate wins for themselves. I think the, let's say, product or managing
I think
group person was not very happy or afraid to have somebody else who's strong leader in that group. I think he never talked to me in the time I was there. He really, I mean, I talked to everybody. That one person, he never, once, on any call or anything, he never showed up, was not there talking to me. Even when we had like a German office, he was once there visiting. I was there, but he was like really not having him. It was strange because it made it for everybody else very uncomfortable. But yeah, it was an interesting thing to see and learn. I mean, I remember how angry I was at the beginning with the company because they were doing so much in my head wrong. Maybe from product development, how you do leadership, I mean, it's totally different to anything I guess everybody did here, how you lead a company, how you set goals, how you want to reach your milestones, how you pushing forward versus chaos and changing every day, your opinions in a big organization, doing reorganization. That's like total different experience for somebody going in.
Zach, I guess your situation is maybe like slightly different because you're obviously still within that engagement. But yeah, what's the?
Yeah, I've still got the rose colored glasses on. We're in the honeymoon phase, but with us, and I know we'll get into the dynamics. Like Autodesk had been a partner for 8 years and an investor in our company, and so the team I joined, the strategy team that Sid Haxar leads. Sid was on the corp dev team, and he invested in us 8 years prior. So I'd known him for almost a decade. I think I knew more than half the people on his team, kind of stepping into it. And so again, we're 5 weeks in, so let's circle back in a year or two. But I did have some of those conversations up front around the role, the expectation, and actually made the decision to kind of step away from the product role to be more in a strategy role. I've been building Rhumbix the last 12 years, and actually was looking for the opportunity to, being more in a strategy role, looking at the bigger picture ecosystem of how can we move forward tools for subcontractors that self-perform GCs within Autodesk more broadly.
Okay. All right, let's move on to the second topic then. This question here is about what fundamentals need to be in place for a business to be an attractive acquisition target. So Yves, I'm going to fire that to you first. And yeah, do you want me to repeat the question? Because I know I just blasted that.
No, sure. It's good. So what fundamentals? So I'm pretty sure we're all gonna have a quite similar answer around the fact that business are bought, not sold. And what that means is that so many of the fundamentals actually depend on what the buyer is looking for, rather than whether you're a valuable company. Like there is plenty of valuable companies that are, that are hard to get acquired because they don't find a buyer that is looking for what they do well. If I can talk about a few characteristics, maybe if you think about AR, I think there is different stages where you can get acquired. I think you have what you can call like a talent acquisition, which is usually you acquire a product, like an early product or a team, and usually like the benefit for that for the buyer is that it's a pretty cheap acquisition. You can usually after that find depressed assets where the company is growing, but it's struggling a little bit, and once again you get a cheaper price. In the case of Hilti, for us, I think they were looking for a few things. Number one, they were looking for a product that was deeply connected with what they were doing. We were doing through software, essentially what we call craftsman productivity. That's what they do with tools. It was a perfect match for them in software, so they liked that. The second piece, I think, is, and we talked about it, they wanted knowledge in software, so they were looking for founders that really understood the full cycle from 0 to 1 on how you create a software company. That was the second piece. And actually, this one is interesting. I think the more time they spent with us with the acquisition process, the more they wanted the company. And the last thing, I think the AR threshold matters because in the case of Hilti, they wanted a business that was big enough that it wouldn't get crushed by the rest of the organization post-acquisition. Because if the business is too small and you put in a $7 billion fish tank, like the sheer pressure of it is going to crush the business and it's going to go nowhere. So that was, I think, those were the primary factor that mattered for them. But once again, we can get in that story later, but like 4 years prior to that, like Hilti just would not have acquired Fieldwire. Their strategy also changed through those 4 years. And the same company that just wasn't interested in us 4 years prior just became like a great target for acquisition. So once again, companies are bought, not sold. I think that's what people need to really understand.
So the point that I can kind of see from that is that like you mentioned timing, but it was actually more to the point that Hilti were actively looking and then found you. You weren't building like around what they needed. It was like a match make that eventually happened because timing was right.
So it's crazier than that. All right, so let's go in the story. I'll try to keep it quick. In 2017, 4 years prior to the acquisition, Hilti was visiting the Valley, and McKinsey, the consultancy, organized a Silicon Valley tour for them. So they reached out to a bunch of startups and they were like, Hilti's in town. Do you want to meet them? Our office was literally like 3 blocks away from the McKinsey office. So we're like, sure, we'll show up. Literally no expectation from our end. The loose idea we had in our head is Hilti is known for visiting customers on job sites. This is kind of like the same persona. Maybe we can negotiate some sort of partnership around distribution. That's why we went, right? We show up to this meeting and we start the meeting and I'm like, okay, guys, let's try to tailor this presentation. What are you guys interested in? And literally the first answer, like they're Swiss German people, super direct. They're like, we're not here to buy. We're not here to invest. We're just here to learn. We're actually super thankful you guys showed up. And we go through the meeting and they realize that there's like literally perfect alignment. Like you change software with hardware, it's their dream pitch. On the way back to the airport, like the CFO that was in the meeting called us and they were like, guys, we want to absolutely do a deal with you guys. We've never invested in a startup, but next time you raise, please let us know. We want to invest. And at the time we were about to start putting our Series B, and that literally preempted the process and we put our Series B together. And then we do that, it's great. And they call us and they're like, guys, I really want you to understand we're investing because we're excited, you guys, but we will never acquire you. This is not what we do at the Hilti. We've never acquired a startup. So much so that when we raised our Series C, usually it's polite to call your existing investors to be like, do you want to maintain your pro rata, which is to keep your percentage ownership in the company? And Hilti passed on the Series C. They said like, no, this is too much money. The valuation is too high. We don't want to invest further. And then we get to the time where we raised our Series D. And at that point, they had gone from software is outside of the strategy of the company to, if we don't do software in 10, 20 years, there's a risk that we might lose relevance for our customers. And the same company that told us, we're not here to invest, we're not here to acquire, 4 years later, just ran like a very strong process on acquiring the company. So yeah, it shows you that things can change very, very fast.
Brilliant story.
Yeah, I think there's like super important. There's like a huge element of luck and like the company's strategy that's completely outside of your control. And like I mentioned, Autodesk invested in us, and at one point in time, we were, at the top of the M&A list in the late, 20 teens, and then they bought PlanGrid and they bought BuildingConnected, and then they had to integrate both those companies, and then Pipe, and then GC Pay, and then in the last year, we rose back to the top of the strategic target list, and that's what kind of opened up the opportunity. But we talk a lot about like some of the questions around the exit journey, and I think it's less an exit journey, and the exit is, a good option at the end of running a good company, building something that's valuable to the industry, building a product that has raving customers, and then that creates the opportunity for the exit. Instead of continuing to grow the company standalone, it becomes an attractive off ramp, but it's less of a journey that, like, if you're setting out to just get acquired, more often than not, that's not going to work out well in the end.
Zach, what's your thoughts on fundamentals being in place to make a business an attractive acquisition target?
Yeah, so I think strategics are primarily going to acquire a company either because they see a young startup as a risk to their core business, something that they need to kind of acquire and pay a hefty price tag to be able to not have them be a future competitor. Like that's one reason. Another is that it's a good fit. It's a adjacent market space. It's a product gap that they want to move into. And when you're in that latter category, it's super important that you actually just have good business fundamentals. And so being accretive out of the gate is something you'll hear, which just basically means like you're not bringing a lot of cash burn. Like if you're burning $5 million a year, it is very, very hard at, especially a publicly traded strategic acquirer for people to justify taking on that burn versus if you're burning less than $1 million a year, for example. And so I think, being able to be, quote unquote, accretive right out of the gate, or being able to kind of quickly know what you need to do to get there if there was an acquisition opportunity is kind of a fundamental that will create more opportunities for you than if you're burning a lot of cash.
Nice. Dustin, how about you?
I don't think people realize it does depend on the dollar value of the acquisition, but I'm sure we all went through some of this. The amount of diligence and money that goes in if you're being bought by a publicly traded company is kind of incredible. I mean, I remember sitting in some of these rooms and I'm looking around. I'm like, I don't think anyone in this room doesn't take home less than like 500K, like 40 people in this room. And it's just like, it's a company's, it's the outside law firm, it's the internal law firm, it's the corp dev department, it's all of my team. And I'm like, we're burning a ton of money. So when you're burning a ton of money, they are dotting every I, crossing every T. They ask you so many questions, and it's like a repurposed question with a different verb or adjective or rephrase, and you're just filling out these forms, and they're just trying to find anything that where they feel like 1 + 1 didn't equal the 2 that they were looking for. And so this is where if you don't have like actual good true ARR, like back in the day, there was a lot of project ARR that people were like, well, how do we actually recognize this? What is the deferred revenue on this? And now, when you have I'm thinking about these AI companies that say they have subscription revenue, but it's really consumption. And like, I think that people are going to start questioning some of the math on some of these companies. So the better you can justify your revenue numbers, what's legitimate, having all of your contracts in order, because some people maybe write a new contract every time. Because I've seen that the enterprise deals, they put in special terms. So now you have to go through and audit every single contract that you've ever written. Yeah, the better you can have those things. I do know that we at Building Connected did an amazing job. That actually, give a shout out to David Stringer, who ran our finance, but the guy was on it. We got through financing or diligence in about 3 months. And that was incredibly quick for that size of a transaction. But yeah, like if you fabricate your numbers, all it's going to do, or like don't account for them or accrue for them correctly, like it's going to cause problems. And then the term sheet you sign can get adjusted. So I think having those ducks in a row is pretty smart. And it takes a long time, because I'll be quite honest. For the first 3 years, I don't think we were the best stewards of our P&L. Like, it takes a while before you mature into a business, and you learn how to recognize that. And I mean, even with Edify today, we're maturing as a business, and we're getting better FP&A processes in place to support those things.
Yeah, to add to that, like looking back 3 years, like you're going to need to generate like documentation that validates like every dollar through the business. So like the earlier you can kind of go through at least a dry run, and do we have all of our IP assignment agreements? Like find a checklist online, do a dry run, and just again, it's a lot easier and you have more time to fix that stuff when you're not in the middle of going through diligence versus in the middle of going through diligence and you find out you're missing a document. And especially if it's somebody that contributed IP to the company, that's not a place that you want to be in.
Oh, I got to bring something up, because so many companies I see do this, and it's so dumb. Don't get your family friend to incorporate your company and start writing your first contracts and those documents, and then think you're going to go get the high-priced attorney that's going to come in and clean everything up for the financing. You need to start with a legitimate law firm that has experiences working with startups from formation all the way through. Because the worst thing you want is to have a new firm come in, or you try to do it with a mom and pop shop that's like a boutique firm that has never done a transaction before. I've just seen a lot of companies that they try to save like a nickel and a dime on some formation docs or drafting their enterprise agreements. They don't know about IP, and they don't know about like cybersecurity. They don't know about indemnities, and they have weird languages in there. Get a firm. There's 4 or 5 big ones in Silicon Valley that everyone's familiar with. They basically all use the same documentation. Why do you want to go against the grain? Be the vanilla company when it comes to all that crap.
And by the way, to your point, they will do it for free prior to your seed.
Yeah.
No, like they will wait for you to raise your seed to be paid. And so just get a top firm. Sure, it's a little bit hard. Just get the social proof that you need to get them, but the threshold is not that high.
I think that's the only thing we never saved money was on lawyers. I mean, I saved a lot of money, a ton of money. Yeah, I was so cheap, but the only thing we spent money on was a good legal firm.
Okay, Mo, how about fundamentals for you?
I mean, you should have probably revenue. That's a good thing. I think that's like their basics.
Although
we don't know. We have so many other the audience, which we have is so broad. I think it's important also to bring up like really fundamental. It's like the basics. The basic is having revenue is a good idea. Showing that your revenue is repeatable, it's a great idea. Having customers who love your product is a third thing, I guess. So that's like really the basics. I think everybody here had customers who loved their products and were champions, and you could find people who would say, hey, this is something we really love and we decided to buy. I mean, that's also how we got acquired was through customer love. I mean, that's like the fundamental of it. I mean, can just quickly give the story. It's like, no, when we were raising our next round, and we had already a term sheet, and then on the same time as we were selling to some customers, like Frankfurt Airport was doing a new terminal, we were selling to Siemens was building a new lab and another big project, and FARO was selling to them on the same week, more or less. And they all on the same time went to FARO and said, hey, we actually want what these guys are selling us, not what you're selling to us. It's something to you coming. Otherwise, we don't know if we want to continue partnership with you. And on the same time, then we closed a multi-year, multi-million-dollar deal with one of the other customers there. So in 10 days, 12 days, they got so much signal up to the CEO, and they said, oh, we should look into that very quickly. And they came in and said, okay, we take the whole round directly. Because they went to the company and said, yeah, we're doing something. We will have something in the next month, coming end of next quarter. So, and nobody knew, okay, they had to come in quickly and do it. And that was like, because no, you're doing sales, you have customers, and you're closing deals are like the best signals for organizations to say, oh yeah, that makes sense to us.
On the ARR number, Yves, I think you touched upon this earlier, but it's one of my things, and I think people always have the same question: is there a ARR number people should aim for, or is this irrelevant?
I mean, so I think there is, back to the types of acquisition, I think there is essentially three types. There is the below $100 million acquisition, and usually that means a sub 10 million ARR. And once again, that doesn't require the buyer to mobilize their entire firm to just make that acquisition. Usually it's more local in nature for the buyer. Then you have the 100 to 400, 100 to $500 million acquisition. That's where you find the bulk of the bigger acquisitions, meaning that, okay, that's the big buy for that company for the quarter or the year. And that's when you get to the, 2-digit million ARR. And there is fewer of those, but I think that's where a lot of value gets created. And then I think there's kind of a gap between that 500 million mark and the $1 billion mark, where there's really not that much action because it's both too big and too small. And then after that, you enter kind of like the IPO, the super strategic acquisitions where Microsoft is buying you or Oracle is buying you, and that's the $1 billion kind. So at least that's the way we were thinking about. When we were raising our Series D, which is basically, that was the competitive process we were running at the same time as the acquisition with Hilti. The choice for us was very clear. Either we get acquired now, or we enter kind of like the long valley, the long desert crossing, where we have to go all the way to just being $1 billion plus company, because there's not going to be any acquisition in between. So in general, that's when I talk to founders that are entering that zone, I'm like, below 500 million or in that 300, 400 million range, there's still a lot of action. Above that, it's really a bunch of one-off companies that are making extremely large strategic decisions. And it's not the same number of acquisitions.
Nice.
Yeah, I think put otherwise, like the higher your ARR, the shorter the list of the buyers get. And at a certain point, you have to bridge that gap to be able to IPO and look, Procore, Service Titan, Equipment Trade, or Equipment Share more recently. The list of construction tech IPOs, I think it's one hand, right? And so, yeah, like you put it well, like there's kind of thresholds beyond which you actually are like pretty exposed. And so, the 100 to 500 million is a great range because above 500 million, like you got to be on an IPO path, or private equity becomes a buyer, and it's like a very different path. You're staying on and running a private equity backed business, and you're probably rolling up a few things and looking to sell it again in 3 to 5 years. And that can be a really good path, but it's definitely a different journey than the strategic acquirer.
Dustin, anything to add? Change?
No, it is super interesting. And I think the natural harmonics that Yves describes for the peaks and troughs of the acquisition market for this vertical that we're in. And I actually think these exist, and they're just different peaks and troughs in different verticals. So I would hope that it actually expands a little bit. I do think that there are going to be some new large market cap companies that might make some moves into this space. And if that does, then you could see the peaks push out and there's be some 750s or 800s. Yeah, I would be excited about that. I mean, if, for example, Palantir doesn't do a lot of acquisitions, but they're now interested in the space, that can drive pressure and competition drives those things up. But historically, that's where it's been, which is also like kind of dumbfounded me. I was looking at a company, I won't say which specific company, but maybe you'll be able to trace it. They raised an A at $170 million with sub 2 million in revenue. This is a new one. There's many examples of this. Where is the acquisition opportunity now? Because no corp dev can go, you know what, here's $250 million check for like the foreseeable future, right? And so it's funny because you can get the capital from people who don't understand where the peaks and troughs are of this market. And if you do that, you can paint yourself into a zone where you're just in no man's land, and acquisition becomes very troublesome. So, I mean, this goes back to a saying like, I was gonna say one. I'm not gonna say it. I would just say that this is one of the reasons why you need to be cognizant of the pre-money valuations you take on and when you take them on. Because if you maximize for the pre-money valuation, you might not maximize for optionality of a good outcome.
I think in that case, what you mentioned, that was not, I mean, if you can grow into that revenue, it's great. I think the people who made that bet that it would go like other similar companies in other industries. You would go from 2 million to 100 million ARR in a year, which didn't happen. I mean, if you have to have that gameplay, maybe then it works, or you know what you're doing on that execution. But otherwise, yeah, it's dumb.
Well, so this is a philosophy I have, and a lot of people don't know this. A lot of people think I'm ultra like risk tolerant, which I truly am because I love startups. But I think half the job of the CEO is to figure out ways to de-risk the startup throughout the process. I don't like stacking on additional risk into an inherently risky industry or company. So by stacking on high valuations, you're giving yourself less optionality in the future. So like, I don't want to add more risk to an already risky thing I've decided to invest my time into, if that makes any sense. And so it's just like everything's a calculation, everything's a variable into this like complex equation of, hey, I want this equation to end with a good outcome. And so stacking on extra risk is tough.
No, but I agree with you 100%. I don't think founders are risk tolerant, but I think the good founders are really good at managing risk, meaning you don't take risk when you don't have to, and you concentrate all of it in very narrow areas where that's where the leverage is coming from.
Yeah.
100% with you on that one.
I think we should do another episode about risk taking and the startup fundamentals at the beginning, how to manage that, and fundraising.
Well,
fundraising options and risk taking as a startup. That's the next episode.
Next one.
Coming soon.
Yeah, I'm starting to realize we've got like 35 minutes left and we still got a load of subjects to go through. So we will definitely have to revisit this. But just to move on swiftly on that point, I'm going to skip ahead to negotiation and get some of your guys' opinions on this. And then we will maybe go back to one other question, and then we'll go to the audience Q&A. So on the negotiation, for a bit of an open and generic question here, but what's a question that a founder should ask themselves before they ever sit down at the negotiation table? Dustin, you're first.
I can't use my obvious first class tickets. No, Let's see. Well, I've only ever really negotiated from a position of leverage in my acquisition because I had another acquirer, and those two acquirers were in huge competition with each other, right? I guess in that framework, I actually think I could have done better. I think I could have pushed harder, and I don't know what I would have done differently, because it was like, it's funny because in order to negotiate, I didn't have I had the leverage in that Procore was also interested in BuildingConnected, but I didn't have the personal leverage in that I was completely broke. So they're both offering me life-changing outcomes. So it was like,
Yeah, I was going to say, is part of it like a bit emotional at one point where you're like, I just need to make a decision. Like, it's super exciting. I need to make a decision. Let's just go for it. And you haven't got the time to think.
we had three good options. We had a term sheet for 40 million at 180 pre, and we had 2 acquisition offers. So it was like, just pick one of the good options.
Optionality then, yeah.
Yeah, there was a lot of optionality.
How about
I don't have a great suggestion. I think that because I think how you negotiate is very, very personalized. Like, everyone has different tactics. I mean, people have different tactics on how they fundraise and their styles. But at the end of the day, usually negotiations are a deep understanding of, if you understand exactly why you're buying it, they're buying you, and how you can determine the actual value that they're assessing on it, then you can figure out what more you can squeeze.
Very good. How about you, Zach?
Yeah, I think another way to kind of frame what Dustin was talking about is like have a good BATNA, understand your BATNA, your best alternative to no agreement. So, in Dustin's case, with any Autodesk or Procore, it's like my BATNA is I get bought by the other one, or I continue to run this company, and so that having a strong BATNA gives you the ability to be more forceful in the areas that you're trying to move, because if you have no leverage and you're just like, the most important thing is this company sells, or I'm company's going under, or whatever, like, you're going to get taken advantage of. You're not going to get a good outcome for your employees, for your investors, and so really kind of understanding the motivations of the buyer, kind of why they want to buy you, and also like, and it's something that starts ahead of time, is like building up that BATNA to be in a position, like the best position you can be in, which is like, hey, I think there's a really good 1+1=3 here. Like, I don't need to do this deal, but like, I'm like genuinely interested in what putting these companies together looks like. Let's explore that together. Frames that negotiation in a way that allows you to kind of find that win-win situation, versus it being kind of a zero sum, or you feeling like you had to give up more in the negotiation than the other side got.
And how about you, Mo?
I think before you go to negotiation, you should know what you want. I mean, what is the actual thing? What is the minimums or maximums you want to get out so you can negotiate? I think that's like the thing. I think for me was to understand at that point, okay, what means winning in life, or what is the price or what you get out of it. Again, understanding the basics, what acquisition means. At the beginning, if you do it the first time, I think for me it was, okay, how the funnel of funds goes, what does it mean? So you should know what you're negotiating for, and then start negotiating or discussing the outcomes. And I think I know just one founder, which was another friend, who really did a great job setting up his acquisition and negotiating, because he created a full show when they visited his office and so on. And he pushed that price so high. I mean, is the best sales guy I've ever seen. And he really did the best, I think,
Cirque
ever,
du
I
Soleil?
would say. Yeah, he really did one of the most impressive jobs in selling his company. Where I think for us, it's okay, negotiating, knowing the price goes up and down, some little things. I would say versus him, that was like real negotiation and selling really the company during that process, and not negotiating. I mean, you want to be bought, but how you then present even much bigger to a new buyer. In this case, I think in the other three cases, the companies knew already the company well. In my case, we were new, but yeah,
Mm-hmm.
that worked well to present us, but not on that level.
Nice. How about you, Yves?
And that's like the
Yeah, I mean, I agree with a lot of what's been said. Acquisitions are pretty emotional journey to go through. And once again, because I think you've convinced your entire exec team that the goal was to go all the way, right? And now you're coming in and you're saying, hey, I really like what those guys are saying, and they would be a good home for the company. And this is the part where this is not a real two-way door. Like if you decide to go in, I think you have to have a good argument. Like in our case, the argument was Hilti has great distribution. We're going to be able to supercharge the company. This is actually a faster path than continuing to do just VC funding. And it's proven to be reasonably right. So I think that was one. Optionality is obviously really, really important. For us, we ran a raise concurrently with the acquisition. The VCs didn't want us to sell, so they were just pushing the valuation. The Hilti wanted to buy before we raised another round that would have made us expensive. So that created a really good dynamic around the acquisition. And there are many ways to do that, but I think it's always important to have options and choices. And the last choice, and maybe this is very specific to us, we realized after the fact that is not a standard way to do negotiation around acquisitions. We really did the acquisition backwards, aka like we negotiated the vision and the price upfront with a very small group of execs. It's basically like 2 founders on our end, 2 execs on the other side at the very top of Hilti. And then we agreed on basically all the terms. And what we said is we're going to do due diligence after that with the much larger team, like the 40 lawyers and IT people and consultants like that are in the room that Dustin was talking about. But none of what they're saying is going to influence the price. The decision at the end of that process is going to be, yes, we're still excited, or no, we don't want to do the deal anymore. But there's not going to be any discussion around, you know what, we looked at your IT stack and it's a little unsafe and we're going to take 15 million off the top. And so that process was great because it really kept the decision concentrated around a really small group of execs within the buyer. And that made the process super pleasant for us.
Oh,
So
I thought it's always this way.
that's called the lockbox, backward acquisition. Most acquisition get adjusted after the due deal.
Okay. Because we also negotiated that and what we wanted out and was very clear, let's say, with the top people at the beginning. So,
Yeah.
and I guess
So
it's
you-
always this way.
You bring something up though, and I actually appreciate what you did because one of the reasons, because you talked about the momentum, and I started looping in more and more of the executive teams before we had agreed on everything and signed a term sheet, was one of the reasons why I didn't do the Series B and took the acquisition, because too many people knew that we were doing an acquisition. I realized like it was hard to roll it back.
Yeah.
And so once that was kind of like people's heads had gotten around there, it became, I was like, oh man, this thing is out of the cage. Getting it back in the cage would have been a Herculean effort. And that was part of like the calculation of like, hey, how do I pull this back? That was actually something I wish I had done better now that I think back.
So to your point, we had 8 people that were part of the early talk. And those were all the people that had the ribcage to take the bad news if this was to fall through.
Yeah.
The rest of the company, by the way, we got acquired in the absolute middle of COVID. So there was nobody at the office. So this was the easiest thing to.
Well, that was the problem. We were doing it in pre-COVID. I had the Procore executives walking around the office.
Yeah.
Like, what are they
I
doing
didn't
here?
have to deal with that. But honestly, I see like the optics, like thinking about the experience for the rest of the company was really a big thing we were thinking about. It's like, how do we make sure that this doesn't end up being discouraging if this doesn't go through for people? Yeah.
In our case, we just said that's part of the investment. I mean, because we were doing the other, we got the term sheet, I was investment, we're saying, no, everybody is looking for investments. And that was also at the beginning what we thought, why they reached out to us.
Yeah.
At the first day. So everybody thought, okay, if we're sending them documents or something, or they have to prepare a report, that's part for the financing. and not taking, let's say, the full 100% of the company versus 10%. I think that kept it for a long time for most people who also participated as, oh, it's part of the next financing round we're doing.
I actually have a very tactical thing to help founders when negotiating. If you are handling the negotiations, first you want to create leverage. Let the lawyers hash out everything until they bring you the terms that you're going to want to go through with the corp dev department. So here's how a corp dev person is going to go to you with terms that they want to negotiate. They're first going to present all the terms that they say, look, we're going to bend on these and give you these things. Then they're going to say, in return, we want these things. They were already going to give you the first things, and they really care about those ones. You can push back on those. That's literally what will happen in every conversation.
Love it. Love that. Thanks, Dustin, for sharing. Okay, let's go for one more in my structure. Then we'll do some of the audience questions that were submitted. This one is, what's a lesson from your exit that's made you a better founder, leader, or operator? Let's go with Mo first.
I think the process really showed me what I want for life, or what winning for life means, versus you're winning for your company, you are in that ecosystem, and also bringing that, let's say, to the new team and executives, what we're setting up to go for and what that means. And the second thing was always to understand also what I tell young founders, not the numbers, how much a company fundraised or they got acquired is like meaningful on their last day, but what after taxes lands on your bank account is there. But that can be totally different. I mean, we had like maybe not the largest exit on earth, but I know that I didn't do that bad versus much other companies who raised much more, had much bigger numbers. And the founder said, I don't know, a third or a tenth of what I got out of it. So I think that's like always something, numbers don't get afraid of those. So that helps also to with the team to explain them how you raise money, because we never had a high evaluation. We never raised a lot of money. That makes a huge difference in it.
Mm-hmm.
Versus the company who raised now, I don't know, on 100 million evaluation.
Yeah, I'll ask you all at the end how much tax you all paid. But moving on from that, shall we let's go to Zach next.
Yeah, I think just a real lesson learned is be very mindful around how you're showing up every day, and like in the middle of a transaction, like I was super conscious of like the next 3 months are going to have, a trajectory shift in the lives of all of our employees, at the company. Like this is a big period in time. And, I think that's true at the exit, but, that's true throughout the entire life of a company, and, trying to really, be real mindful about how you're showing up, how you're preparing, how you're being there for your employees, and trying to put yourself in the shoes of the employees, and behaving in a way that if you were not the founder and you were an employee of this company, that, you would be really respectful, or you would have a high level of respect for how the founder was operating and executing during this critical period of the company's life.
Mm-hmm.
Yeah, I mean, I think for me, like having a super highly functional team of execs, this is why it is so important. Like the 8 people that I was talking about that led these acquisitions, they were all like hyper talented. It was divide and conquer. We crushed it. And, this is why you don't settle on your execs, because you need to be able to trust them 100%. Like literally, you're going to send 2 of them in a room. They're supposed to cover, for example, all the customer security for the consultants. And if somebody fumbles, that might just kill the deal. You don't know. And so we had nothing to hide, but we also had a killer team to run that thing. And it took us a long time to build a killer exec team. But those are the moments where you're super thankful, because that's a very intense experience. The acquisition process is one of my best memories from Fieldwire. A little bit like our first fundraising, which was incredibly hard and we sucked at it and we had to learn through the process. But when you just prevail and succeed in the end, you're like, damn, this is what life is about. So yeah, have a great exec team. Just never settle on that stuff.
Nice. Dustin?
So when I was a founder, was constantly worried that, Autodesk or Procore would do what I was doing. Because I would just think, man, if I had that many resources, just think what I could go do. Like, why can't they do this? And then after getting acquired and getting to see how large organizations operate, I no longer have that fear. Like, that has been removed from my mental stress levels are just lower. I would love to try to compete with me in what I'm doing as a startup and the ability to execute and hire really smart people and build the team, the executives. Love it, because then you're going to beat them and then they're going to be like, God, we should just buy this company. So that is like the greatest gift, because it would stress me out all the time. I remember one time Procore called me, we're moving into pre-con. I was like, oh my God, they're going to beat us. And no, they didn't. They built a bunch of shitty software. And that's what big companies do. They build shitty software. And then they realize they built shitty software and they need to buy the actual good companies that are actually working on the problems. So that was the one emotionally freeing thing to come back and be an operator in Contech again. Like, I do not have that fear. I hope all the big companies try to do what Edify is doing and we just kick the crap out of them, because we will.
always, Dustin. Nice. Okay, very cool. Right. So next, let's say another 10 minutes or so, we'll go. I've got a couple of audience Q&A questions. And we touched upon this earlier, but maybe this is a subject people want to hear more about. So if you could go back in time, refound your company, what's the one thing you do different in terms of choosing your business entity, tax election, shareholder, operation agreement, and so on? Let's go with Yves first.
I mean, I don't think there's a ton. If you're set up as a C corp in Delaware and you did what you needed to do to set up your QSBS, which is a way to get I think it's a federal tax offset on a meaningful portion of your exit, you've done everything right. And just do that with real lawyers. Just don't do that. Don't do that on your own. Back to what Dustin was saying. I think you got 99% of it right. And after that, just focus on creating value. Even this is my only advice for founders. They're always obsessing about valuation and stuff like that. I'm like, none of this matters. At the end of the day, if you crush it as a company, there will be plenty of value to share. If you do okay, well, there's going to be a whole lot less. So yeah, C corp in Delaware with real lawyers and QSBS, you're doing just fine.
Very good.
Yeah. Qualified small business stock. The first 10 million is tax free at the federal level, but you have to hold for 5 years. And so familiarize yourself with that, and then don't spend any other energy on tax strategy. Build a good company product, and customer base.
Very cool.
California still taxes.
They do.
Yeah, of course.
live in a low tax state, or a zero tax state, right? Texas, Florida, Washington.
Oh, yes. Move to Florida.
There you go.
Yeah, Dustin, have you decided where you're moving yet?
Still.
Dustin likes tax states.
Dustin, do you have anything to add to about the founding? And
I agree 100%. If you're wasting mental energy on how do I optimize my taxable event other than I set it up as a QSBS, or you don't even have to do anything. You just set it up as a Delaware C Corp. You award yourself the stock. You purchase the stock for 1 cent, your founding stock, and then you just let it sit there. There's some other creative things, like technically speaking, you can set up individual LLCs where you give ownership to your wife or your cousin in those, and then they have to be autonomous, and then you're playing these games. Like, I know people who've done it, and then you're playing this game. I feel like you're missing the forest from the trees, because while you're working on all of that, you're not doing what Yves was saying, which is focus on creating value. Because like all of your value is going to come from, like, when we're talking like BuildingConnected is a $300 million exit. Like, if I could have got 20% better or 50% better, we're talking hundreds of millions of dollars, like, rather than this taxable event, like where you're talking about some percentages. I think that's just missing it. And what people are also missing is it's not just the financial outcome that is beneficial for you for the rest of your life. We get to come on these shows and people, believe us when we say things. And because we built a company that someone found value and actually got acquired. And if you're a successful founder, like, that has value. So focus on creating good business. And then, like, things are good after that. I mean, you're still going to have troubles in life. There's still financial issues. I'm not FU rich, but I don't worry about what I order on a menu anymore. So that's nice.
Lovely. How about you? How about you, Mo?
One thing I would add in general is that as a group, we are not a great example, because the chances that 4 startups who started, let's say, were at a seed stage, or maybe starting to raise a pre-seed and seed stage and meet each other and all get to an exit in the same industry, the chances are very rare. And I guess we were really different backgrounds and totally different industry. So the odds how that ends that were really low from statistics wise. Yeah, I think that will not happen for most other companies now and so on. So that's also a lot of startups die. I mean, we had a lot of competition, each of us, who all died. Not every of us had companies coming in and going out with nothing who died. I mean, we motivate people to do startups, but no, it's also, we are just the ones who got lucky and we knew each other and were together. But all of our competition usually lost or are still, in my case, still running their businesses 5 years in or 6 years longer, which would have drove me crazy to do the same thing without innovation, doing the same thing, still going. But I think that's also important to know, just as we're talking about this topic. And it looks like, oh, you start a company and you exit it on the end, which is not true for everybody.
Mm-hmm.
Just like the saying goes, Conan, what's great in life,
Very nice. Okay. Let's do one more then. And I know the person who submitted this knows who they are. It's a fun question for you all. Lighthearted to end this discussion today. And hopefully you won't end up falling out over it, but let's see. So if you could be the first hire at another of the panelists' companies, so either of yours here, which company, who would you choose and why? I will go with... I think you are all smart enough to give a political answer as well, so I don't mind asking this to you lot, but I will go...
I'm not political on it.
No, okay,
I can answer it.
Mo, go for it. You go first then.
I mean, I try. I mean, when I started thinking about doing another job or starting working again, and I would start to maybe do a startup or not, I also met with Dustin. I think he was doing his seed round, and I asked, hey, maybe not direct enough, said, okay, he is doing, but he had already a CTO. His mind was in his finishing that fundraising. So he didn't hire me. So I had to start my new thing now. Let's see how it goes, because we're in the same space very much now. But let's see.
But you agreed to my thesis. Remember, you WhatsApp me and
I
you're
love. I mean, your
right
thesis stayed with me. I mean, I really agree with you. We have different ways tackling a lot of the problems. We're on a different side, but I would, yeah.
So you'd work.
I mean, also we met, but
you'd work for Dustin, but Dustin wouldn't let you work for him.
That is not
true. Okay, anyone want to volunteer to go next?
I'll get next. I'll put another one for Dustin. He exited for the most of this group, so that would have been nice to be the first.
I think Fieldwire was more, right?
We're like around 325.
Yeah. The honest answer, they're like, I've never been on like a two-sided marketplace and building a network, and I think that's like super exciting. At the time they got acquired, they were having really exponential growth on the marketplace. I've been in the trenches, hand-to-hand combat with, direct field sales for the last 12 years. And that can be a grind. And I think the network and marketplace aspects that BuildingConnected was able to generate is just a different business model that I would have loved to, have had exposure to.
Very nice. Yves, you go next. Don't pick Dustin.
I'm not going to pick anyone. To be honest, I think I'm cursed with being a founder because I'm a terrible employee for people. I think I would probably be insufferable as an employee for any of those guys, and they would fire me right away. one, especially if you had a good exit, meaning that you have financial freedom and you can do anything. I think you should do anything. And like the chance that what I really care deeply about is what Dustin or Zach or Mo cares about the most is unlikely. So yeah, I know what I'm going to do next, and it's going to be probably to start another company, and I'm unlikely to go work for anyone or big corp. I like freedom too much.
Yeah, very nice. Dustin, how about you?
Oh my God. Probably Mo, because Mo complements the assets I don't have the most, because he's the technical side of the equation. He's highly technical. Yves is probably next in that. But like, honestly, I kind of agree with Yves. I would be I'm a terrible employee, to be quite frank. I don't think like, unless you're giving me something, just go own this, like, leave me alone, check in every 3 months. I'd be a terrible employee. I would love to work with all of them, though, in some capacity. Like, it would be so fun to be in the trenches doing sales with Zach, or it'd be fun strategizing like a business operation with Yves, or thinking about like technical ways to accomplish like stuff with Mo, like, and how we change the paradigms of how we think about some of this data architecture that, like, I'm sure you're going down, Mo, and I'm thinking about it all the time. Like, I have so many. I just got back from advancing pre-con, and people are like coming up to me after my speech, and they're like, you might be fucking right about what you were saying. Like, this is starting to make sense. I had all lunch where they're like, we're with a major GC, and he's like, Dustin, you are going to change this entire industry. I'm 100% bought into what you're doing right now. We need all of our data into Edify, because if you do this, like, GCs can't compete that aren't doing it. I agree with that. But I think what Mo said actually resonated with me, and it is crazy that we really all started in the same town, the same time, all brick and mortar. Fieldwire brick and mortar as well, right?
Yeah.
Yeah, all brick and mortar. And there was so many companies that were started at that same time. I just think it's super interesting that we all connected and gravitated to each other. I don't know if that's just like, I tell people, like, the best, if I was a GC, you know how I'd evaluate software is I'd ask, hey, what tech leaders at tech companies you respect, what tech leaders do you also respect? Because that's the best way to know who's a good company. It's like, because we all know we know the pretenders from the contenders, you know, but it's so good to do this.
Yeah. As you guys are like reminiscing a bit, here you go. I'm going to share the picture for you.
Oh my God.
Yeah.
It's great photo. I mean, we look younger.
Yeah.
I look fatter.
But younger.
Yeah.
The Dustin, you've actually improved that. It's good.
Wow. Great way to end. That ended cascaded very nicely to the.
Whose office was that?
That was Mo's office.
Was our co-working office.
Up at Runway.
That's good, man.
Peter Grant, he's still operating.
They're doing great, from what I heard.
Yeah.
I haven't seen Peter in forever.
Who's the fifth person?
Peter Grant from
like
Stateside,
right?
Yeah. They pivoted into Foresight, which is like an insurance broker.
Makes sense.
Nice. Okay, guys.
Yeah, back in the day, man.
Well, thank you all so much. I hope everyone got some value out of this. I certainly did. And maybe we'll do round 2 sometime soon. Thank you, guys.